Let's take it back home. The Fed's making changes to the stress test for insured mortgages. This leading to concern that a lower bar to entry could only inflame prices in Canada's largest housing market. Steve Saretsky is a Vancouver realtor, author of SteveSaretsky.com, and joins us now. Good to see you again, Steve.
Thanks for having me on, Greg. Always a pleasure.
All right, so here we had this criticism that the stress test was too stringent. It was pricing too many Canadians out of the market. They've come in, at least acted right now on the insured spot, making it a bit easier to clear that bar. What do you think the effect will be? I mean, it kicks in April, right in time for the spring selling season.
Yeah, talk about perfect timing. I mean, not if you're a buyer anyways, in terms of where the prices might lead to. I think that all we have to do is sort of look. I mean, I can speak specifically here in Vancouver, but even nationally, home prices are still accelerating, up, almost 5% year over year in January. And if you look at it right now, we have the tightest inventory levels on a nationwide basis since 2007. So I think that we're starting to see some upwards pressure on prices. Vancouver is rebounding as well. We're seeing the low-end affordable segments of the market are really quite hot, a lot of multiple offers. So I think by lowering that hurdle for the benchmark on the stress test, could potentially add a little bit more fuel to the fire, so to speak.
Does it strike you as strange, Steve, everything that you and I have discussed over the past couple of years, all of the policy levers that were pulled at the local level, at the federal level, trying to cool these markets down, and then you show up and say, let's make the stress test just a bit easier, when the markets, as you said, have already found their footing and are starting to recover? Does it just strike you as odd?
Yeah, well, I mean, I think you could make the argument that, the qualifying benchmark was, not really moving with bond yields. Obviously, we've seen a huge drop-off in bond yields and in mortgage rates, and that benchmark never changed. I just think that the timing of making the change is probably not the greatest, again, as we're seeing the market starting to heat up again. I mean, I look at it, residential mortgage credit growth, it's growing faster than it did today. Than it did back before the stress test was announced back in a couple of years ago. So Canadians are still borrowing a lot of money. It seems like they've kind of absorbed and have gotten around the stress test, or at least have gotten used to it.
The great debate right now in Canadian housing seems to be about supply, that we're not giving enough product to the market. We're seeing tightening up in some of the key markets. That, of course, could inflame prices as well. But there seems to be a disagreement as to who is driving this demand for supply. If it's investors, the argument, I guess, is you can never supply enough for investors if there's a hot market. What are you seeing in Vancouver?
Yeah, I mean, I think in Vancouver anyways, our market has shifted back from sort of the offshore investment and even local speculator mindset. It's kind of shifted back to this local market. And so we're seeing most of the hot, the activity, the multiple offers, that's all happening in one-bedroom condos where first-time buyers are trying to enter the market. There's just not enough supply there. We're seeing a lot of demand for entry-level single-family houses, under sort of 1.5 million. That's where all the activity is, but we still are actually seeing a really soft market in the expensive luxury product, anything over 2 million. There's a lot of supply, and it just really, there's just a lack of demand from offshore as well. So we're still seeing some prices actually inch down at the high end, and the low end is actually prices are starting to creep up again. So it's kind of interesting to see the compression happening in the market.
Now, when it comes to this change to the stress test, of course, as we said, it's about the insured space. This is what Mr. Morneau is talking about. But the banking regulator, OSFI, said we're looking at basically doing the exact same thing on the exact same timeline. Then we have some other people saying, wow, we thought the Bank of Canada was probably going to cut rates in April as well. This seems to be a whole confluence of events. It would be the entire mortgage market in terms of that new, easier stress test, perhaps maybe even a cut to that benchmark rate from the BOC. This could really set things off, I imagine.
Yeah, I would hate to be the BOC right now. Good thing Poloz is getting out later this year, because I think that they're in a really tough spot. Obviously, I think the highest policy rate in the developed world. I'm sure they would love to cut rates, but I know that they've talked a lot about being cautious about stoking household debt and house prices. But it seems like we're bringing in all these various policy measures, foreign buyer taxes, stress tests, and prices in the Canadian housing market continue to sort of rise unabated. So I'm not really sure as a policymaker what you do at this point. It seems like we're kind of just throwing things at the wall and seeing what sticks.
Now, if we worry about affordability and we took those worries to Ottawa, they might say, well, we have this first-time home buyer incentive, help you get into a home. Not many people I've talked to in the industry have told me that there's all that much interest in it. Is there any interest in this first-time home buyer incentive in Vancouver?
Yeah, no, I don't think there seems to be a whole lot of interest. I think that, based on the price points here in Vancouver, what I'm seeing, at least with clients, is, particularly these younger first-time buyers, is they're getting help from mom and dad. Mom and dad have made, good money in the market. They're passing down a lot of that wealth, and so people are getting up to 20% down payment. I've had clients, get up to 25, 30, 35% just because the cost of the mortgage, they have to drive those costs down just to be able to carry it. So we're seeing larger and larger down payments just to try to absorb, the carrying costs of housing here in Vancouver.
Now, Steve, you mentioned earlier that when it comes to the high end of Vancouver real estate, there's still a lot of softness there. You're not seeing that offshore money. If that is the case, even if we see an acceleration of home prices because of the easier stress test, is it not going to get away from us like it did before? Because there was really a lot of activity in the high end market where we ended up seeing 30% year-over-year price gains.
Yeah, I don't really see that. I mean, again, maybe stranger things have happened. I mean, this bull market's kind of defied logic. But I personally don't really think that you're going to return to those euphoric levels that we had. I mean, again, if you look at a lot of segments of the Vancouver housing market, a lot of them are still well below their peak valuations from a couple of years ago. It's really just the affordable product that is kind of lacking in supply. There's just a lot of demand for that. Obviously, credit remains cheap, and for the most part, everybody still has a job, so there seems to be a lot of demand for that affordable product. And truthfully, I mean, even from the development space, a lot of the development has been focused more on the high-end luxury market, and so we haven't really been building a whole ton of maybe affordable product, and a lot of that affordable product that has been built is actually still under construction, so hopefully we'll see some of that complete and come online later this year.
Steve, it's always great to get your insight. Thanks for joining us.
Thanks, Greg. Thanks a lot.
That was Steve Saretsky, Vancouver realtor and author of the SteveSaretsky.com blog.